The person that's coming to the stage next is someone I probably talk to daily and harass him about different things because he's one of the guys that controls the money. Now, we told you about credit earlier. We told you about how to acquire a house for your first time and why you need to know about rehab and 203K loans and 203B loans and FHA. Now we're going to get, for you investor-minded folk, we're going to get into how you get the money to actually flip a house. That's the next conversation. So we're going to get into funding. The person I'm about to introduce to the stage has been, this company has funded me $100 million would be an understatement in the last few years to get properties, to buy, fix, and sell them. He's going to go through every single step of what to expect, how to get the money, what to do with it, and how not to make mistakes. And also, we will get you guys approved, or at least we'll get the application to get you approved. If you're ready or you're not ready, you'll find out on the spot today, and we'll help you put deals together. Chris himself, Chris Nimmons from Gauntlet Funding. This is the guy. You need money anywhere in the country, this is the guy you get the money from. My man, Chris Nimmons, Gauntlet Funding.
All right, so like Lance mentioned, my name is Chris Nimmons. I work with Gauntlet Funding. It doesn't matter which title you want to use for me, but at the end of the day, I'll see you through the application process, processing your files. I'll get it through underwriting. Right down to scheduling the closings, I'll probably be involved. Brief background on me, I've done everything from, I'm still currently a licensed real estate agent, but I've done rentals, I've worked with buyers, sellers, tenants, investors. For a while I wasn't a private lender, but I worked with private lenders. I've done traditional loans. We had somebody who did 203K products. So I've touched on a little bit of everything, and here I am now. I ended up in the hard money space to kind of help more people acquire deals because I didn't know hard money existed originally. So every time you see an ad or somebody saying, oh, I buy houses all cash, I just assumed, oh, they've got the money in their pocket. They've got $200,000 to buy this deal. They're buying it all cash. That's not always the case. Come on. Left or right? I'm trying to figure this out. There we go. So, a little bit about Gauntlet Funding. We lend in almost 50 states. To date, we've funded close to $250 million in loans. I'd say it's probably been a little bit higher than that, but for now, we'll say $250 million. So, the principals of the company, Lou and Raphael, they were recently in the Private Lender magazine, so we just figured we'd throw that up for a little posterity stake. So, I already gave you a background on me. Now, one thing that people talk about a lot is the power of other people's money. Because like I said, I had no idea that there was funding in place for investors. I assumed that when somebody bought a house, they bought it cash. Realistically, they're using other people's money. So I'm sure you hear that all the time, other people's money, where do you get that money from? There are private lenders, there are hard money lenders. You may have friends or family who have 401ks or any number of savings accounts that you can use to kind of fund your transactions, but I'll get into that a little bit later. So the reason that people preach other people's money is because the name of the game is leverage. Let's say hypothetically you do have $200,000 to invest in a property. The second you tie that money up in one deal, that's it. You're not getting paid until that property closes. Meanwhile, let's say you do a loan at maybe 80% of purchase price. That right there, you've put down $40,000, you're sitting on another $160,000. You can do another deal, you can fund your construction, you can do marketing. So there's a reason that hard money exists, and this is one of the reasons why, to kind of give you leverage so that you're not putting all your money into just one deal. So this is just a little bit about the history of hard money. Essentially, there are two ways to get fundings for your deals. Private money, which can be your own or someone you know's, or hard money. Now, true private lending, it varies in the amount of expense because let's say I go to Lance and I'm like, hey, I want to fund this deal. Lance could say, yeah, I'll do the deal with you, but I want X% of the profit, or I want to be partners on this much of the deal, or the rehab money comes out of your own pocket and he won't reimburse you because it's Lance. I'm kidding. But there are just different reasons why there's hard money and private money. So how many people here have taken out a hard money loan, or you're familiar with hard money in some form or another? Okay, there's a couple of people. And have any of you done deals with hard money already, or you're just aware that it exists? Okay. All right. So after let me just gloss over the private money side, because it's not very easy to come by. At the end of the day, again, it's someone you know. More often than not, it's someone you have built a relationship with. That person is trusting you to, see your deal to completion. Once you sell that property, you pay them off, and maybe they'll lend to you again, or maybe they just gave you this money to do this one deal, and now they're more interested in doing other things. So hard money now it's more along the lines of, this is where Wall Street gets involved. It's not just a handshake. It's not just, hey, we've gone to school together for 10 years, or we've known each other this amount of time. Wall Street's gotten involved. So now they want to see what you look like on paper. This is basically like qualifying for almost any other loan. The only difference is there are different caveats and, I guess, different means of which we would qualify you. So it's not always going to be, oh, you have this, this is your credit score, this is how much cash you have to work with, this is as much as you get. We look at it as a per deal basis, and we look at your experience as well. So I'm just going to touch on the application a little bit. Oh, well, this is basically kind of how Gauntlet Funding funnels. So we've got Wall Street, we've got banks, we've got family offices. The little supposed guys in these slides are other private investors. Because what happens is they come to us with however much capital they have, and they say, look, we need a safe investment, we want to see reasonable returns, and we want to take as little risk as possible. So Gauntlet Funding comes into play because we take these funds and we aggregate them into, you could call it a pool, and we use those to fund your transactions. So this is the first page of our application. How many people here hate filling out paperwork? See, nobody raised their hands, which is a little surprising. I hate filling out paperwork. So, all right, that means I trust all of you. When you fill out the application, it's going to be done right. So first page of the app, fairly straightforward. We're just asking, your name, where you live. Oh, man, it doesn't look great. It's fine. So we ask for your name, your current place of employment, and we ask for your attorney's information. Reason being, once we start a transaction, 9 times out of 10, we're going to go directly to your attorney for some of these details. When you'll see later on what kind of documents we require, and you as an investor, your job is to be out there finding deals. You're not going to be able to send me all of these documents or check for STIPs or look for updated items that I'm requesting, so we're going to be going to your attorney a lot of times. One thing that I believe the very first person mentioned was the importance of credit in general, whether it's a business loan, whether you're getting a car loan, whether you're purchasing a property. Your credit does matter. It's not the most determining factor, but it's important. The FICO scores do restrict who we can lend to. There's a certain threshold, and we look for compensating factors to kind of overcome that. The second point about interest reserves or credit affecting your possible need for an interest reserve, that's not as applicable now simply because on every loan we do, I'd say we're looking for a bit of an interest reserve. Now, what an interest reserve is, that's payments up front. Now, don't go thinking, oh, I've got to pay all of this interest for this loan up front, and if I close in 3 months, they're just, they collected these payments. That's not how it works. It's more along the lines of prepaid interest, and, you close the loan in 3 months, and let's say we asked for 6 months of interest, you get the remaining 3 months as a credit on your payoff. So don't go looking into this like I paid all this money up front in closing costs and I'm not going to see that back. So just keep in mind that for the time being, an interest reserve is pretty necessary, only for the simple fact that we're seeing a lot of changes in the market. So just be aware that, when you get those net numbers at closing, it might be a little bit bigger than you were expecting. So background checks. What we do on the background check is we're looking for primarily financial difficulties in the past or things that we can get some sort of understanding of. You know, if you've got a speeding ticket doing 95 and a 50, we're not worried about it. It's fine. Don't be too concerned. But if we see something along the lines of a recent bankruptcy or a foreclosure that wasn't tied to, let's say, the market crash, we're going to need a lot more detail on that. You know, a lot of people were hit very hard in 2008, 2009, 2010-ish around the whole, you know, the financial market crashing at the time. So when we look at your background check, if we see a foreclosure and it's in that time frame, we're going to need an explanation, but we're a little bit more understanding of that as opposed to you having a foreclosure in 2020. Well, let me rephrase that because we're all in a very weird space right now. Let's say 2019 is when the foreclosure is. I'm not certain we can really get around that, but it's still something that warrants a conversation just to get an understanding of your situation. IRS liens and judgments. When we pull these background checks, a lot of times what we can see is a lien from the IRS or a judgment, and the way that's remedied usually is we'll want to escrow for it at closing. So all that means is you're either in some sort of payment arrangement with the IRS, and we need documentation of that, or we want to hold the funds to pay off the IRS separately. Reason being, first in line is always the government. Doesn't matter what you're doing, government comes for you before anybody else. So experience. Now, when you're completing the application, you're going to see a couple more pages of the application in a minute. We look at different factors to determine your level of experience. So properties currently owned that generate income. Are you a buy and hold investor? Are you somebody who does fix and flip deals? Are you, a wholesaler, as Lance may have mentioned, or someone else? We look to see how experienced you are in the type of deal you're looking to get into. So while we're putting this together, you'll see that we need number of properties you sold, the timeline it's taken you to sell those deals, the number of projects you've completed, the types of projects. Because if you do a lot of 1-to-4s and all of a sudden you want to get into a commercial deal, then we have to look at that differently, because the sale of a 1-to-4 property is very different than the sale of a commercial asset. Oh, and the cost of the renovation. That's something that's going to come up later as well. So this is just one of the pages about the real estate owned. So as I mentioned, we're just looking to see if you're an investor that buys properties to hold for rental income, and all of a sudden you want to get into fix and flips, we're fine with that, but we just need to take a deeper look at the level of experience that you have. This is a schedule of real estate sold. So this is where we're looking for the types of property you sold, the number of properties you sold, how much it's costed you to renovate those properties, how long it took you to sell them after the renovation, because we want to know, okay, what's the timeline on this investor getting in and out of this transaction? If they're going into a fix and flip deal and you see some of them have taken a year or two to sell, not an issue, but again, we need to know that this is your average timeline so we can help determine your profitability. All right, verifying assets. Now, there's a laundry list, or seemingly a laundry list of items that we're required to review your file in earnest. We're going to need bank statements at some point. We're going to need, copy of your most recent photo ID. And we're just looking to see that you have cash to close, you've got cash in reserves to make your monthly payments if you need to, or if you have renovations to make, that it's not going to hinder you at some phase in the process because all of a sudden you tore down walls and you see, I need to do more to the property. Can you still bring this property to completion, or are you now stuck? And the carrying costs of the project, again, that'll cover like your mortgage payment, taxes, renovation costs, things of that nature. Now, one of the most critical parts of any loan, whether it's hard money, traditional, 203K, it's going to be the appraisal. When we're doing the appraisal, we like to order them with an as-is and after-repair value. Essentially what you're looking for is what's the property going to be worth once it's fully completed. Because you could buy an asset for $200,000, it needs $30,000 in work, and all of a sudden you have a $400,000 asset. That's a pretty good deal. You know, you've got a lot of subsidized equity in that deal. If you're a buy and hold investor, we're gonna need like a rental addendum to know that when you buy this house and refi into a long-term vehicle, the rent's gonna cover your payments and you're still gonna walk away with a little bit of profit. Because at the end of the day, we're about making prudent loans. We wanna make sure that you as the investor are successful, that your projects are completed properly, and at the end of the day, you walk away a satisfied customer. The impact of the scope of work on value. You're gonna see in a moment what our scope of work is. I believe Ralph mentioned that in the 203K product, the importance of the scope of work. Now, when you're putting together a scope of work, we always advise you use a contractor. Use someone who knows how much it's gonna cost per square foot to do the job, someone who's walked through the home and they can say, look, you know, it needs new floors. This is how much it's gonna cost to do a new kitchen. These are the new bathrooms that are gonna cost. We're gonna finish the basement, and they need to get you as accurate of number as possible. Reason being, when the appraiser walks into this home and he sees whatever the current condition of the house is, some may be in a state of disrepair, some might look okay, maybe just haven't been updated since the 70s. The appraiser needs to know what you're doing so he'll know, okay, this property will be comparable to these other properties on the market. This is the value we can get you once it's all repaired. So the scope of work is very important. And this is our scope of work template. We have handouts, so you'll get what a sample scope looks like. If you want a copy, ask us via email because it's a fillable Excel. Because we want to make sure that when the scope's being done, you don't just write it in and then it can't be changed or it's illegible, because the scope comes into play at a second phase of this deal. So not just in appraising the value, but at a later part, the scope becomes very important again. So the anatomy of a deal. This is basically just a rough loan structure so you guys can get an idea of what it looks like to do a hard money deal. So we've got a contract price of $250. Borrower came to the table with 20% down, which is about $50,000. So our initial loan, the loan that we're gonna issue at closing, that's gonna be used to pay off, prior liens or give cash to the seller, in this case is $200,000. Now, contractors walk through the home, the borrower believes, and his contractor believe that the scope is for $100,000. So to bring this house to its highest and best use, $100,000. The after repair value is $450. So you see here where it says total loan amount is 65% of that after repair value. Just like any other loan where the 203K product can go up to 110% of that after repair value, we're capped at 65. Reason being, this is an investment deal. You're looking for subsidized equity. So you're looking to get something below market value, needs repairs, and once you're done doing your job and you list it on the MLS or wherever you list it through, or you use it through a brokerage, the maximum value of the house should fall in line with about, let's say, $450. That's the reason why we order an appraisal, so we can get an idea of what your house will be worth once you're done the work. So, like I said, we're capped at about 65% on this particular deal. In some cases, we can go up to 70, but for now, I'm gonna use 65 as our number. So notice now where the repair reserve is only $92,500. Reason being, after we do that initial loan to pay the seller, pay off the prior liens, we only have so much room to fit in repair money for you. So we were able to fit $92,500 into that. Now, some investors can get the complete job done at that price. Others will need the whole $100,000. You have to be prepared to put that additional skin in the game. In this case, $7,500. Now, it sounds like a lot of money, but when you see what kind of profit these deals turn for you at the end of the day, that's not a huge amount. But again, every time we underwrite a deal, whether it's gonna be me or my colleague Lou or someone in our office is gonna give you a call and say, look, these are what the numbers shake out at. We've got an appraisal for X, we can lend Y, and these are, this is how much of your repair money we can give you, and we always advise taking the repair reserve. The reason I do that, when you start a project, you don't know what's gonna come up. You might have $100,000 in your bank account ready to do the renovations. You tear down walls, or you lift the floor, or you get into the basement and find that there's mold. All of a sudden, that $100,000 budget has now become 125, 150. So what do you do in that case? You only have $100,000, and now you're stuck using those funds. Can you still complete the project? Or where will you get the additional funds to bring the property to completion? So the reason we suggest the repair reserve is because, again, you're just leveraging other people's money in this case. It's a very low-cost option. The repair reserve is sitting there, and you don't have to take it if you don't want to, but at least it's there if you need it. So you do the renovations to the property with your own cash, and you decide, you know what, maybe I do need a little bit more money. At least you have the repair reserve that you can call on and say, hey, Chris, I did everything in the scope of work. I know you have $92,000 sitting in an account for me. Send an inspector. I need those funds back. Excuse me, you have a question? You only pay interest on that money when you draw down on it. So that $92,000, while you may pay a couple $100 in closing costs maybe, you don't pay interest on it until it's used. So you're only paying interest on the $200,000 until you start pulling against the repair reserve. Once you say, I'm 50% complete with the job, send an inspector. You're going to start paying interest on the 50% of that $92,000 that we give to you. If you get 100% of the repairs, then you're going to pay, interest on the total balance of the loan. Mind you, hard money loans are interest only. So that's one of the benefits as opposed to like an FHA product or a conventional loan. You're only paying interest on this money. Once you sell the property, you pay the initial loan off, and you're out of the loan. All right, determining profitability. So now, this internally is how we kind of go through your deals to make sure that at the end of the day, you're walking away with something. Because we're not going to write you a loan if these numbers don't make sense. If we put your loan together and we see you're at a loss or you're below a certain threshold, we'll tell you, look, can you negotiate with the seller, maybe get a slightly better price, or are you sure this is the deal you want to get involved in? Because that profit can quickly be eaten up by any number of things. Again, unforeseen repairs, usually that's the big one. Unforeseen repairs eat into that profitability. So we've got your purchase price, what the value of the property is, our loan amount, and that 65% again, where it came into play. We're at 65 of the ARV on this deal. So now, time to flip. That varies for everybody. Some of you will do a deal and it'll take you 3 months start to finish between closing, finishing the renovations, and getting it back on the market and even selling it. Some of you will take 6 months. Some will take a year. Some might extend past that year to 15, 18, maybe about 18 months. We haven't seen many go further than that. But that time to flip factors into your profitability, because the longer it takes for you to sell that home, the more you pay in interest, the more you pay in taxes, the more you pay in utilities to keep the lights, the water, all of these things on so that, the home can remain habitable or ready to be sold. Mortgage tax, transfer tax, mansion tax is applicable everywhere, title insurance, broker's fee. So those now are part of your closing costs. We calculate those on your exit, because when you get into a deal, again, you can negotiate with the seller, you can maybe adjust your scope based on doing different type of labor to the home. So those things we take into account beforehand. Once it comes time for you to sell, we're again taking into account when you offload this home, where's the profit coming from? So once you pay a broker, we assume 4%. That's what most realtors charge. You can't get past transfer tax. Mortgage tax, you're going to pay that regardless. So we take those into account. Property tax and maintenance, we have it at about 1%. In some places, it's a little bit higher. But again, it's just us trying to figure out, when you sell the home, are you going to make profit on this? So obviously there are legal fees, cost of the appraisal, other fees add up. And on the flip, this particular borrower's return on cash investment is going to be about 22%. So again, when you're doing these deals, it's very important that you understand your numbers. We have a loan calculator on our website that you can use at any time. It's free. We're not going to ask you to sign up or anything. You can just use the the profitability calculator on our site. So now this is just one of our case studies. I think this might have even been a deal we funded with a certain somebody who's running this event. So you see the before. Again, it's a home that looks like it hasn't been updated since maybe the early 90s, possibly 1980. But after the fact, with the level of work that he's done, I can't quite recall how much the home sold for, but there's a drastic change. Once you do this level of work to a project, you can see a huge increase in value of the property. So most of these other slides are probably going to be case studies, but before I get into those, does anybody have any questions? Yeah, I can't really see with the lights, but. So everybody follows me so far. You're understanding kind of the process behind hard money and its importance, right? Okay.
Yes to yes, right? You get it?
All right. Oh, go ahead. No. So hard money loans we do not do in your personal names. Those are always done under corporations. Now, that actually takes me back just a little bit because when we said credit does matter, these hard money loans do not appear on your credit. There is personal recourse, you are a personal guarantee on these loans, but it does not appear on your credit. So some people are concerned that, when you run my credit or, when we do these loans, it's gonna ding up my credit because I've taken out, this huge loan. Doesn't appear on your credit report either. So these loans are not issued to individuals. They're done strictly to corporations. So this was just another, case study. Basically, the borrower purchased the property for $600,000 with a hard money loan. It needed 300 renovations. And as you could tell, value shot up to almost $1.3 million because look at the level of work that they did. It almost doesn't even look like the same house. Yeah. So, but again, notice that the scope was $300,000. For that amount, you can build a brand new house in some places, or you can, redo a property to the point that it doesn't look like what was ever there before. So if you Google map this house 5 years ago, you just think that you have the wrong location because these are two completely different looking homes. But again, $300,000 does a lot to the renovations of a home. Again, here's one in Long Island. Purchase price of $305, rental budget was close to $90,000, and the house later sold for $575. So all in, this investor's sunken cost was about $391, and they sold it for $575. That's over $100,000 in profit, even after paying off the initial loan, their closing costs. So when you're doing these deals, just keep in mind, the level of work you're gonna do is gonna drastically impact the value again. Now, I wasn't gonna touch on new construction because right now it's a product that we're still refining. It was here for a long time. Thanks to COVID, things shifted a little bit. But new construction is something that can be done in the very near future. So I believe you had mentioned something about owning land in Texas. I would say give us about 30 days. We should be able to kind of help you build something on that property. But now, here's the thing. When you're doing something with new construction, we're gonna need surveys, architect letters. There's a lot that goes into a brand new construction of a property. We're gonna need feasibility studies. So just keep in mind that a new construction is not as easy. I'm sorry.
Gosh, Chris.
I'm in the zone, Lance.
You mentioned that hard money loans are not done through a personal credit, but through a corporation.
Right.
Does the corporation have to be seasoned in order to?
No, that's actually a good question. Now, it doesn't always happen, but when I'm dealing with investors, I always advise them to start a new corporation under that LLC. There's a variety of reasons why. When you're investing in a deal, you don't want too many things tied to that one LLC. It doesn't necessarily have to be an LLC. It can be any kind of entity. But you don't want 6 different properties tied to one LLC or one entity, and then, God forbid, something happens. Someone gets injured on your property. Everything is now, everything's at risk under that LLC because they all are tied to that one entity. So I always advise investors to start a new one. If your corporation is over a year old, or actually if it's a year old or older, we'll need what's called a certificate of good standing. It varies from state to state. Usually your attorney or your accountant can help you get one of those. The certificate of good standing just lets us know that you've paid your taxes, you've paid Uncle Sam, and you don't owe the government any money, and that it's still an active corporation. Because, I'm guilty of it myself. I formed a corporation like 2011, never used it. And, it's one of those things where I'm sure I owe the government maybe a couple $100, but it's one of those things where if your corporation is not in good standing, we will not issue a loan to that. Because again, what did I say before? Uncle Sam is the first person in line all the time. So we always advise, start a new corporation. A simple method of doing so, some people use LegalZoom. I prefer advising you to use an attorney, and start it in the name of the property you're buying. Once you know for sure you've got a deal that's about to be locked up, call up your attorney and say, hey, look, I'm buying 123 Main Street. I want to start a corporation. I plan on taking a hard money loan. What do I need to get it in order? He'll get you your filing receipt, your operating agreement, your EIN number, and he'll form it in whatever name you want. Now, there are some investors who, like I said, they'll form one corporation, do a deal, sell it. They'll either sell the corporation or the property out from underneath it, and just reuse the corp. Entirely up to you. But again, consult with your attorney, your accountant, and definitely speak with us before you kind of close. Because I want to know how you're structuring the deal. I want to make sure that however you have this set up, the loan is secure, your asset's secure, and you're not worried about any kind of recourse against multiple other properties you may own. So like I said, new construction, that's a product that's coming back in the very near future, but I'm not going to touch too much on that right now. This is just more of the new construction. Now, the differences between hard money and traditional loans. Sure.
In terms of the cost of these loans, what's the ranges of interest you charge, and also how many points, let's say for someone, new investor?
Sure.
I know it's based on experience.
Okay. So I normally like to wait until I have a complete file before issuing terms, because I mentioned compensating factors earlier. So for newer investors, if you've got, very good credit, very liquid, but this is going to be your first deal, it depends on how much you're putting down. From that point, I can say, look, we'll be at 10.5, 11, 12. But remember, these are interest-only loans, because people hear these rates and they're like, why am I paying that much? Interest-only loans, and they're only for 12 months. Now, if necessary, we can extend a little bit, but we have to speak about that. But again, the rates kind of vary, and so do the points, because I don't have enough factors to determine what that's going to be. The riskier your loan, I'd say the higher your rate is, but right now our rates cap at 12. So a simple number to remember is 1% per month for 12 months. Just keep that in mind.
Let me chime in on that real quick for you, Chris.
Yeah.
When it comes, a lot of people start asking that question, especially newer investors. They want to know what's the interest rates, what's the points, or whatever have you. Mm-hmm. Understand, in these loans, you're typically borrowing 80% plus of the renovation cost, 100% renovation, and 80% plus of the acquisition of the property. So you might say to yourself, oh my God, 10%. I hear that the market's like 3 or 4. This is not FHA, this is not conventional.
Right.
This is an investment product. You've actually acquired a partner that's gonna put up between 80 and 90% of the money for you, and you're gonna pay him 10% a month. So if you're borrowing 200,000, like you said, think about 1% a month. You're gonna pay $2,000 a month for the money.
Yeah.
So now typically when you have a partner, you guys go 50-50. If the project costs 200, you put up 100, they put up 100, and when it comes to splitting the profit, you get half of it. He's telling you 10% a month, but he's putting up 80, 90% of the money. There's no better partnership. So a lot of new investors start to get spooked, get scared, they get leery of interest rates when it comes to hard money.
Yeah.
But there's no, think about it. If you're not gonna get the money from a business partner willing to take risk on you, and only take, only takes 10%, 20% down. Like, what is the other option? When they say things like, that's high, I'm like, compared to what?
Yeah.
What are you comparing it to? Are you comparing apples to apples? What are you comparing it to? It's high compared to my house that I live in. I pay 3.5%. That's because you live there.
Yeah.
The government's not looking to take a risk on you and become your business partner for you to flip houses, but he is. So I just wanted to add that part as far as interest rates are concerned, because a lot of people.
That's usually what I get into
misconstrue.
when I sit face to face with people, but you know. Oh, you've got a question?
So when you said you start a new corporation if you're going for like a commercial property and stuff like that. So how are you determining the income based on the loan?
Sure. So one of the earlier slides that I had was one, profitability. So this one right here. So we take into account your purchase price, you know, the after repair value of the property, what our loan amount's going to be, you know, the length of time you're going to hold that loan, and your usual closing costs. So what will happen is, like I said, in this example, purchase price of $250, value of the property is $450. Our loan, our total loan was $292,500, which is 65% of the after repair value. So you see here where it says interest 12 and points 12, we take that into account too. So whatever fees you're paying to borrow this money, we take that into account as well. Because at the end of the day, when you sell this home, we want to make sure that you're making money on it. If it's something that you plan on keeping as a rental, we have a different metric we use to calculate that. So we'll order an appraisal with a market rental addendum to know how much income the property will generate. If it's just a flip, this is our standard kind of review of how we process those deals. So this is how we understand how much profit you stand to earn on a flip. But if it's something you plan on holding, speak to me. We'll put the numbers together and see how it makes sense. So that was new construction, right. So differences between hard money and traditional lending. So hard money must be against a residential or a small balanced commercial asset. Right now we're gonna focus on the residential. That means 1 to 4 family properties. Oh, I'm sorry, got a question?
When you submit the scope of work, do you submit a draw schedule with it? Like for the first draw, you doing demoed, roughing, you need this much for this draw or not?
That's not necessary. We've streamlined our draw process to be as effective as possible, because by the time you put together a draw schedule, whether it's prior to closing or after the fact, it could slow down your project. So the way we process our draws is you call me up or you send me an email, hey Chris, I did roof, gutters, flooring, whatever it may be. We fill that out on the scope of work that you provided at whatever percent you believe it to be. Because if you say, I did 50% of the roof and I need 50% of the roof money, we send an inspector out. If he confirms that, you get 50% of that line item based on the reserve we held for you. So if the repair reserve is $100,000 and your scope is $400,000, let's say the roof cost you $15,000. We'll give you $7,500 back. But again, you lay those funds out first. You call us, let us know that the work's complete, we confirm it, funds go right back out to you. That way, project never stops. So now, again, hard money and traditional lending. Oh, was that another question? Oh, I saw a light, no problem. So now, hard money must be an investment property. So if you plan on living in that home, you cannot go hard money. That's what the 203K product is for, that's what conventional lending is for. We cannot lend against an owner-occupied asset. It just doesn't work that way. The term for traditional loans, 15, 30-year loans, sometimes 10, 12 months for us. Hard money, 12 months. We don't want to be tied to you forever. The goal is we get you in, we get you out, and we move on to the next deal together. Because the longer you're paying 12% interest, the less money there is for you as an investor to make that profit back. So, end of the day, 12-month term, again, we understand that some projects may take a little bit longer. We can offer extensions, but we have to speak about that on a per deal basis. Tax returns not required. Now there's a caveat to that. We don't normally require tax returns, but if you're the investor who's looking strictly for acquisition funds, you know for sure you don't need repair money, you're looking for the best rate possible, you just want to get in and out of the deal, we do have a product that uses tax returns and we give you very competitive rates on that. So usually it's not required for the standard hard money deal. We're not going to need your tax returns, but if you're somebody who's, you know you've got the cash and reserves to bring any project to completion, you don't need repair money, give us a call, we'll talk about it, And there's a chance that, we'll ask for tax returns if you're very rate sensitive. But again, like Lance mentioned, who else is going to offer up 80% of the money for interest only and a couple of points? Not many people. Even private lenders sometimes will not offer you such good terms. They'll want 50% of your profits or more. Now, one thing that's mentioned here is about the habitability of the property. The 203K product, it has its uses, but hard money excels in places where a 203K product is not viable. We've got properties where there's burn damage, flood damage, and there's no way that they could, there's no feasible way you think you could get that deal done in 6 to 9 months to bring it back to habitability. We always advise hard money. Because again, you get a draw, we have funds in reserve for you, you bring the property to completion, you flip it, you move on, and it's just one less thing for you to worry about. So it doesn't matter the condition of the home, whether it's habitable, it could be something that's, in tear down condition. We speak about it, we figure out what the best strategy is, we put together a hard money loan, you get into the deal, you get out, and you move on with your deals. Now, traditional loans. One thing that I'm not certain if it was mentioned before was the length of time it takes to close like a 203K product. It may have been mentioned, I might not have heard it, but it's not going to be in the same time frame as a hard money deal because we don't require as much paperwork and due diligence to issue a hard money loan as you would for something backed by a government-sponsored entity. So FHA and conventional loans, they take 30, 45, 60 days, possibly longer depending on what it is you're trying to do. Hard money, as long as you get me everything I need, we can close you in as quickly as 5 days. There have been instances where we closed sooner. Now, some of you may be thinking, why does it matter how long it takes to close? Someone's gonna come up later to discuss short sales. Short sales, even REOs, they're very time sensitive. When you get into a situation with a bank that's willing to offload a property, all they care about is who can move quickest. You wrote me an offer a week ago, how soon are you looking to close? If you can't close in the next, some banks will give you 30 days. If you can't close in 30 days, they're on to the next buyer. It doesn't matter if you got the cash together on the 31st day, they're done with you. So when it comes to deals that you have to move very quickly on, hard money is the way to go because again, 5 to 10 day close time. So that means from the moment I get the application from you, once that appraisal hits my lap and I review your scope of work and everything looks like it's in order, 5 to 10 days, you're at the closing table, the property's yours. You don't have to worry about losing that deal to somebody else or the bank pulling it from you for whatever reason. Now, again, traditional lending, you can't often close with violations. It's possible in some very select cases, but closing with violations is a big no-no. With hard money, doesn't matter what let me not say it doesn't matter what the violations are. We can close with open violations against the property. Again, it's one of those things that we just have to review, but I'd say 9 times out of 10, we can close with open violations on the property. All right, so eligible properties. I mentioned this briefly before because that's what I'm going to focus on today, the 1 to 4 families. Basically, REOs, short sales, private sales, estate sales, we can close those. Some estate sales are a little finicky where there will be multiple heirs to an estate and they'll sell off sections. It's cumbersome, but we can help you close those. When it's an REO, basically that's a bank-owned property. Let's say Wells Fargo foreclosed on something, they want to sell it, that's an REO. Basically, bank owns the property, they've taken it back, they've completed the foreclosure process, we can help you purchase that. Short sales, I believe Lance mentioned earlier, where, you owe the bank $300,000. I'm sorry, not you, but seller owns the bank $300,000, house is worth $200,000, but there are violations, it needs renovations. So realistically, they negotiate the short for 1 and change. We can close short sales all day long. It's basically the backbone of our business. We get so many short sales that I could probably write a book on just the closing of short sales. Mixed use, residential over commercial, I believe was mentioned earlier. Right now, that product exists, but again, it's just something that we handle on a case-by-case basis. Reason being, When you value a mixed-use asset, we're going on a cost per door basis. So that means how much are each of the residential units worth and how much is the commercial space worth. So that's a completely different appraisal. It's a longer process, but mixed use can be done. Apartment buildings, 5 units and over, it's commercial. Again, it's something that can be done with hard money, but we just treat it on a deal-by-deal basis, because once you get over those 5 units, it becomes basically it becomes a different type of appraisal, because we have to go by the cost of the property. So the cost basis means how much income does the property generate, and is that enough to substantiate a certain value? That's how they value most commercial assets. Ground up, we briefly discussed. I'm gonna gloss over that. Modular homes and manufactured housing. So again, this is just to show you how green I was when I first got started in real estate. I had no idea that modular homes really existed to the scope that they did. I just assumed when people said these things, they meant trailer parks. I'm like, who's investing in trailer parks? Turns out there are a lot of people investing in trailer parks, but that's not what these are. These are like prefab homes where a construction company builds the property, they ship it to a location and they set it down. That's where that house resides from then on. So modular homes can be done via hard money. Determining your exit strategy. So one thing I had asked early on, are you a buy and hold investor, or are you somebody who does fix and flip deals? We look at each deal very similarly. The ARV is very important, but again, if it's something you're gonna hold, we're interested. How much income does the property generate as a rental? Reason being, when you refinance out of this loan and you're getting into a long-term vehicle, you're keeping the house for 10, 15, 30 years, we need to know that at the end of the day, whatever the income is for that property will pay your mortgage. Because we don't want you to get into a deal where your monthly payment on the mortgage is gonna be $3,000, and if you rent it out, you're only making $2,500 a month. You're coming out of pocket for $500. You're losing money on that deal. So we look at these based on your exit strategy a lot. So when we put these files together, you say, hey, Chris, this is gonna be a flip, but I'm also open to doing it as something I wanna keep. Okay, great. I'll order the appraisal, I'll get me a rental addendum, and I'll just see what the property yields as something you keep. The burn method. Now, I'm sure some of you have seen, bigger pockets, or I'm not sure if Lance has discussed it at some point, but the burn method is essentially you buy, you renovate, you rent, you refinance, and you repeat. That's a long-term strategy. That's for investors who are looking for, I'm trying to generate rental income every month. I bought the property, it was below market value, I've done the repairs to bring it up to standard, I'm renting it out because, you need that income, and then you refinance. Now, the refinance component, there is an investor takeout, and there are also traditional loan products for that. When you refinance, they will, in many cases, they will not give you a loan on that property until it's debt servicing. So what that means is, like I said, you want the property to generate income, and you want it to cover your mortgage and also, generate a little bit of profit for you. So that's where the refinance comes in. And then, of course, any savvy investor, once you kind of develop a routine, you just repeat it. Do it again. The sequence of making money. So that's kind of why you're all here today. Knowledge, contacts, money. That's basically the order of everything. You came here to learn. You came here to educate yourselves on becoming real estate investors. You came here to kind of understand what your strategies are, how you can get financing for some of these deals, where you can acquire these deals, who's gonna help you acquire these deals. Now you've got the contacts. You've got me, you've got the event organizer, Lance, you've got the speakers up here that he's brought here. Those contacts are gonna help you every step of the way. Whether it's me with hard money, Eric with the credit repair, I believe Joe is here to do the contracting. He'll explain how contracting works, renovations and all of that. Everyone you meet here today is gonna offer you something of value to kind of take you to the next step on your real estate investing career. And then, once you have the knowledge and the contacts, and you know how to structure your deals, you know how to get these things closed, and you know how to get it going, then comes the money. You started making your profit, and now you can invest in more deals or bigger deals, or you can invest with partners. A lot happens once you have the knowledge and the contacts to kind of proceed. And this is the Q&A section, Again, there's my contact information, and does anybody have any questions about hard money at all, or anything with kind of how we review these deals?
I know you mentioned something about like the Burr effect and the refinancing. Is there a time frame after you purchase a property and you go through the motions that you have to wait? Is there like a wait process before you can refinance?
Yes and no. So the reason I say that is on a vast majority of deals, there's no wait period. At the end of the day, let's say it takes you 30 days to finish the project. You've already got tenants in right away. You can start that process for the refinance. The reason I say no is I know with the acquisition of some properties, there's a caveat to how quickly you can do certain types of financing. So that it's on a deal-by-deal basis, but I'd say a majority of the time you can just assume that you can get out of the hard money loan quickly and just get right into a long-term vehicle. So I would say conservatively 30 days after closing, because we also want to make sure that all the docs are recorded. So we want to make sure we've got updated title, we've got the mortgages are recorded, the deeds recorded in your corporation's name. You want all of that in place with the county before you try to refinance. Otherwise, it's very difficult. So on average, I'd say conservatively keep it at about 30 days. Any other questions? Sure.
What's the requirements when you go to refinance?
The requirements on the refinance, we could speak about it in detail after, but I guess let me just give you the over-encompassing view. So we'll treat it just like a hard money loan, but it's a slightly lengthier process. We're going to order a new appraisal. We need to ensure that the property is debt servicing, so you've got to have tenants in place. Like I said, the usual mortgage docs have to be recorded, so mortgage, the note, deed, all of those things that tie into a closing have to be recorded with the county first. And I'd say the most important part of the refi exit would be that appraisal. So it's got to be a debt servicing property.
So it's not like you have to like when you get your own personal house. Is it the same process of getting that mortgage as to when you refinance? That's my question. It's the same process. Like I need my W-2s. I need my all that stuff.
In that case, it depends on what product you're going for. So there are some loan products that don't need tax returns in order to refinance into a long-term investor vehicle. But like I said, that product's not ready just yet. COVID kind of put a hold on that. But if you were to go with a traditional lender, so let's say you own a property already and this is your investment deal and you acquired it with hard money and you're looking for a long-term refinance, as long as there's enough subsidized equity in that deal and you take it to any lender that'll go Fannie, Freddie, FHA, you'll probably still have to go through the same process. So when the investor product is back, give me a call. I'd say like about 30 days from now, that should be in place. But if you're gonna go with a more traditional lender to take you out, then yes, you probably have to have the same requirements.
I appreciate you.
Yeah, no problem, man. I know, we all just had lunch, so I can see a lot of drooping eyes. I get you guys, but go ahead.
What is your loan minimums?
So the loan minimum right now is $100,000. Any other questions, anyone? Oh, I'm starting to see. Okay, I mentioned lunch, and everybody was like, "Wait, no, you're right. I'm sleepy. Let me start asking questions." Go ahead.
The long-term vehicle, do you refinance through a business loan, or you do it through a personal loan, or do you do both?
That's a good question. So just like the hard money loans, if you're coming through us for the refi exit, that's going to be another investor grade loan. So it's going to be done in your corporation. I have to double check the new guidelines if it's going to appear on your personal credit. I don't believe it does, but again, let me check. But yes, it will be under your corporation.
Okay, and the requirements are a little bit different than the personal ones, like your credit score and stuff, or are they the same?
I would say they're essentially the same. The only difference is for some of the investor products, we won't require tax returns. That's the only thing to keep into account. Aside from that, we're still looking at, like I said, the long-term product's not here just yet, so I got to see what comes down the pipe, but we're expecting, 660 credit scores, and then the usual items, bank statements to show liquidity, properties rented out, a market rental addendum in the appraisal to confirm that, no matter who you rent the property to, it's generating income and it's sufficient to pay a majority of the loan off.
All right, thank you.
No problem. I think he had another question.
The previous question the guy asked, he said, you said that the minimum was 100,000,
Yeah.
right? So say I got two houses that's $50,000 a piece. Could I still get funding for two at the same time, or would I have to do one at a time?
Okay. That's another good question too, because it's not something that comes up often, but what he just asked was a question about cross-collateralization. Now, with all the alliteration, it sounds like a really big, scary new thing. It's not. Essentially, what he's asking is, if I have two properties, can I acquire financing against the both of them concurrently on the same loan? Yeah, you can. But the reason that we mentioned the $100,000 minimum is take into account your scope of work. Let's say you have a house that you want to buy for $80,000, but the scope is for $30,000. We lend you 80% of your purchase price, maybe 85, plus the 100% of the repairs. That right there, you've exceeded the $100,000 minimum, and you don't have to. But if you have multiple deals and you're like, look, I want to lock up these two properties right away, I need a hard money loan. Can you do it? Yes, we can lend you, we can do one loan against two assets. All right, so I guess that's my time, because the timer's not working, so thanks, Lance. But thank you, everybody. And we have a booth in the back. If you have any questions, feel free to reach out to me. And, I hope to help you guys fund a lot of deals.